Recording is in progress. Hey, everybody. My name is Tiffany Ward, based in Richmond, Virginia, current multifamily investor. And today we have Bessie. Bessie, I'm not going to butcher your last name, but we have Bessie all the way out from California. She's going to be talking to us today about her multifamily investing journey and how she made the leap from single family into multifamily. So, good morning, Bessie. It's morning for you.
Yes, yes. Thank you so much for having me, Tiffany. Excited to be here and share all my knowledge with the audience and hopefully
Oh,
add
the
a little
knowledge.
bit of value along the way.
Yeah, I'm so excited to have you. So I actually got to come out and see you a couple weeks ago, and I told you I was going to be doing these webinars,
Yes.
and then we just made it happen. So I'm excited to have you. If you can, just jump in and tell us a little bit about yourself, kind of where you're from and your journey, like how you got started, all that stuff.
Yes. So I'll keep it brief and mostly centered around real estate, but I'm originally from Bulgaria, grew up behind the Iron Curtain, so during very different times in a very different place. And at the time, my first exposure to investing was real estate because it ultimately was success for a lot of people to be able to own their home, um, potentially a second family home, which wasn't very common, and then investing in precious metals, gold, silver. So investing in hard assets is what I was exposed to from an earlier age, just by virtue of the environment. Never really knew the stock market until I arrived to the US, and it was always my dream to arrive to the US. And the only way to make that happen, at least in my case, was to get a full academic scholarship. Otherwise, financially, that wasn't feasible. So I came here and kind of followed the traditional path of going to school, getting good grades, eventually joining a firm and starting to climb that corporate ladder, until one day I realized I was actually climbing the wrong ladder, and there were a lot of clues along the way. Just took me a little bit longer to pick them up, but I'm so glad I did. And it was a number of things. One was the 0809 financial crisis, which left a lot of people on the street without a job or with their 401ks and retirement plans collapsing. Subsequently, over the years, my own employer went through a couple of restructures, and at that time I was spared, but that's when the bell rang in my mind, and I thought, well, look, I can't control the markets. I can't control how companies restructure or structure, but what I can control is my own retirement portfolio and how I introduce some diversification away from the stock market. So at that time, that little seed that was planted back in Bulgaria germinated, and in those moments of crisis, you resort to, I think, what you're most familiar with. So I thought, well, I will just buy one home and that will be my small retirement nest egg. And so being in California, that was a challenging process. Why? Because I also wanted to create another income stream. And in order for properties to cash flow here, they require pretty substantial down payment. And the prices here are already pretty high. On top of that, the business environment is not very friendly, particularly from a landlord regulatory environment. So that pushed me to look out of state. So I bought my first single family home out of state, and of course did my diligence, leveraged my lender background because that's what my W-2 job was. And that worked well, which led me to buy a couple more properties. And I think that's when the light bulb went on. And it was the moment when I realized, well, this is not just a small retirement nest egg. That could be my way to diversify away from the stock market. This can be actually something bigger and potentially an entire income stream that could replace my W-2 job. And so I thought, well, how do I scale from here? And when I did the math, it became apparent pretty quickly that I have to buy a ton of single family homes in a very short period of time to get that amount of cash flow. And that's when I took a step back, considered various options, and decided that at least for me, making the transition to multifamily made sense for a couple of reasons. One was the desire to scale, which I was looking at, as well as leveraging my background and my experience as a commercial lender, asset managing my residential portfolio. And while they're two different asset classes, there's still a lot of similarities or transferable skills I can apply as I'm scaling up. So officially made that transition, and now have a small multifamily portfolio, a couple hundred doors, and looking to grow and scale from here.
I love how you say you have a small portfolio, and I'm like, hundreds of doors. No.
Well, I mean, I guess I compare when you hear a lot of
Mm,
the big names and syndicates, they talk about 3, 4, 5,000 doors. So like, I'm still
yeah.
in the beginning of the journey, you could say.
I know, I
Yeah.
love that. So I love a few things that you pointed out there was just like your transition to the States, kind of your mindset that I think a lot of us have as far as climbing the corporate ladder. It's like, okay, you go to school, you go to college, then you get a job and you work and you save and you put your money in 401k and you put it in the stock market. And then you realize like you're not really progressing, you're not really building wealth. Um, so I love that you were able to see and recognize, okay, I still like these hard assets. I'm going to invest in single family and I'm going to acquire a few doors. And I think a lot of us start out that way where, it's like, oh, I learned I could get 10 doors in my personal name and then I'll hold them and sell them off eventually. But then you realize still like you're not picking up that momentum. And then you reach the point, right, where you say, okay, I want to acquire these multifamily assets, which allow me to get 10, 50, 100 doors at a time, right? To really create that wealth, to really give you more freedom,
Mhm.
because we're doing a lot of the same work, right? It's just, it's easier to scale once you figure out those processes and realize that to manage all of those single family homes is just as much effort as to manage those multifamily homes. So, talk me through maybe your first multifamily deal where you kind of got into something 5 units or better. Talk me to how you found that deal, like what made you pull the trigger, you were ready to do it. Can you talk to me about that one?
Absolutely. Yes. And just as a point of clarification, as I was beginning my journey or decided to make that transition, there are really a couple of ways one can approach the process. You can scale up passively, or you can scale up actively. And I can talk about the passive element as well. But in my case, I decided to scale up on the active side, which means I'm one of the operators adding value via the skill set that I bring to the table, and capital as well. And so in my case, the first step, frankly, even with my single family journey, is I start a new venture, I focus on education, right? Because at the end of the day, you have a fiduciary responsibility initially towards yourself and your family. But down the road, as you scale up in multifamily, in most cases, you partner up with other people, other operators, passive investors. So you have fiduciary responsibility towards your investors as well as your operating partners. So education is key, and that was the first step I took. Did a deep dive, even though I had the experience on the lender side, so one side of the equation, I didn't necessarily have the experience on the operator side. So that's why it was important for me to get educated, and I did that in a couple different ways. Of course, read a ton of books. There's a lot of social media educational content, and last but not least, I joined a mastermind, multifamily mastermind, which not only provided a educational component in a more structured manner, but it also provided an access to a network of like-minded individuals who paid as well to be part of that mastermind. So they were equally motivated to succeed, and you could say somewhat vetted. So once I got in, I did two things, and it really boils down to focus. I decided to focus on a skill set. What is the skill that I can apply, leverage, and add value to others? Because at the end of the day, that's how we grow together, is by adding value to one another. And secondly, focus on the market, especially in the beginning. I think that's incredibly important. Down the road, as you grow and scale, you can definitely diversify into multiple markets. But in the beginning, it's very helpful to hone in on 1, 2, at most 3 cities and really learn the markets, the streets, the dynamics, the key players, key performance indicators. because that really helps you evaluate deals and investment opportunities. And in terms of skill set, given my commercial lending background, given the fact that I naturally gravitate towards numbers, I focused on underwriting. And so once I made that decision, I got to work. And I'm not saying this to get accolades or to brag, but it is a lot of work. And before I got my first deal, I underwrote nearly 200 properties, and of those, only 5 were LOI worthy, and of those 5, only 1 penciled in. So I say all that to really say that this is just a normal part of the process. It's a numbers game. So for those people who are making the transition now, don't get discouraged if you don't get a yes on your first, second, third, or even 10th deal. Really, you have to look at a lot of deals before you find the one. And even when you find them, there may be other people who are either outbidding you or maybe have a different type of resume or bring something else to the table. So don't get discouraged. Just keep at it, keep plugging, and know why you're doing it. Have your goals really clear, and that guiding light, right, will help you keep moving forward. So yeah, so that's how I found that first deal, and then the second deal followed shortly after, because all along I wasn't just reaching out to brokers and underwriting deals in the market that I decided to focus on. In my case, that was Orlando, Tampa, and Jacksonville. I was also building relationship within the mastermind that I'm part of, outside of the mastermind, because at the end of the day, when you find a deal, you have a very limited time to close, 60, maybe 90 days. So by the time you find a deal, you really need to have the infrastructure laid out. You need to have your property manager, your lender, your insurance broker, and most importantly, your partners. So I was doing all that in parallel while calling brokers, responding to brokers, underwriting deals. So by the time that one deal penciled in and we were awarded the LOI, I already had in mind, these are the people I will likely be working with based on prior conversations, based on their investment goals and objectives. Here a couple property managers, a couple of insurance brokers, and a couple lenders that I had in mind. So I'll pause here because I know I shared a ton, but
No, that was good content. That was
yeah.
good content there about the mindset, right? Finding a mentor and a group of people, like-minded individuals that help you along the journey, building your team. And the key thing I wanted to point out is that it sounds like it's a full-time job, which it is, to be an active investor, right? So this is, I know at the time you were working your W-2 during the day and at night and in the morning and maybe on your lunch break, you were trying to answer calls and build rapport and underwrite deals and, build these connections. It really is a full-time job that you take on to try to pursue wealth and to pursue this passion that you have. So I wanted you to talk a little bit about passive investing and how you help people who maybe they don't have the time. Maybe they work 60, 80 hours at their full-time job. Maybe they have a full family, whatever it might be. They don't have the time to kind of add that full-time job of being an active multifamily investor. What does that look like for the person who wants to be passive?
Yeah, that's an excellent question. And I invest passively too. So I follow that journey as well. And in my case, my passive investments are outside of the residential space in other asset classes. And that's how I diversify my own investment portfolio. But that's definitely another way to scale and build wealth and build that income stream, achieve tax efficiencies. And there are 3 key areas that for passive investors that I recommend to focus on. You don't need to be an expert on everything, right? That's the job of the operator, and you're really relying on them to do the deep dive as well as do the day-to-day management and execute on the business plan. But as you're approaching those investment opportunities, the 3 things to focus on are: 1, the operator; 2, the market; and then last is the deal. And so as I started this journey, it was by virtue of being active, right? I connected with a lot of other operators, and a lot of times people ask me, where do I find these operators? Well, it's in forums like this one, right? Where you bring a lot of, I guess you yourself are an operator. There are a lot of conferences, meetups. That's a great way to connect with them in other investment forums. And then I found it beneficial, and that's why I advise others, at least that was helpful for me, is join their newsletters, social media pages, and that allows you to get to know them over a period of time. So by the time a deal comes on the table, you already know the person, you already know how they think, you already know what other classes they specialize in, how they invest. Because at the end of the day, as a lender, I like to say people pay back loans, right? And at the end of the day, I think that applies to multifamily or real estate investing in general as an operator, right? The operator can make or break the asset. So that's where it starts from. Secondly, the market. You want to make sure you're in a growing market with good fundamentals, population growth, job growth, income growth, and job diversity. Of course, the operator will share a lot of that information with you when they typically present the investment opportunity, but you want to trust but verify, do your own diligence as a passive investor, and there are a number of resources where you can quickly do that and at least formulate questions if you find any discrepancies between what you're being presented and what your own research is showing. And then lastly, the deal. That's where the at least basic underwriting skills come in handy. Again, you don't have to be a lender, a pro, or anything like that, but at least have basic understanding of the key assumptions to look at and dig into. And again, the operator will be able to walk you through that. But again, as a passive investor, it's totally doable. I know people who are full-time passive investments, right? It all starts with one opportunity. And so it's important to take that first step. Because just like anything, I like to run, so I equate real estate to marathons, right? It takes time to build up to it. So the sooner you start, the earlier. But it's not uncommon to see passive investors building a pretty, over time, not overnight, but over time, building a substantial income stream that can be an alternative to their W-2 or their daily grind.
Yeah, and I know for me personally, I'm both on the active side, right, with my properties, and then also on the passive side. So on the passive side, I'm investing in some of my retirement accounts. It's for tomorrow, it's nothing for today. And then on the active side, it's kind of, things that I'm hoping to take advantage of more in the short term. But definitely, I would say for a lot of people, I think a lot of people get wrapped up in being active, right? Especially for those investors that I know that are doing single families, they're doing fix and flips, they're wholesalers, things like that, realtors. And I think you really need, like, to beef up your portfolio, you need to be doing some of the active and the passive together to really build out your wealth. And for me, that's the goal, right? How do I create wealth for myself, for my family, for my community, generations to come? So talk to me a little bit about, like, if you had to give 3 key metrics, maybe for the active investor, and then I'll ask you again later for the passive investor, that people should be mindful of in today's market. So 3 key metrics for the active investor first, and then I'll ask you about the passive.
I would say for the active, I'll keep returns on the side, because again, it's what you put in, you get out what you put in. But how to quickly evaluate a deal, the first one would be the break-even occupancy. That's really your cushion, and what that is effectively takes the stabilized net operating income, the stabilized effective gross income, and you want to make sure that exceeds your operating expenses and debt service. So usually I like to look at a number under 80%, which means 20% of your tenant base could either stop paying or completely vacate the building, and you're still generating enough revenue to cover your operating expenses. Then number 2, I would say, is cash flow on day one. And a good indicator for that is what active investors usually refer to as positive leverage. And how I measure that is the yield on cost divided by your interest rate. Yield on cost being your stabilized NOI divided by your all-in cost for the property, which is usually the purchase price, the capex, and then your closing fees. And then your cost of debt is usually your interest rate. And then last but not least, so we talked break even, we talked cash flow day one / positive leverage, and last but not least is the operating reserves. Again, that's your cushion, especially in today's market. It's very important to have that. And there isn't a magic number. What I personally like to see is 6 months of operating expenses and debt service, because again, almost inevitably things will go wrong, and you cannot predict everything that could go wrong. So the question is, how do you mitigate the risk? How do you mitigate the unknown, the things that you cannot control? And it's exactly through those levers. You want to make sure you're cash flowing, that you have sufficient cushion and sufficient reserves.
I love that answer for the active investor. And I know we got a little bit technical for some of you guys. These are key terms and key metrics that we need to be mindful of, right? So definitely revisit this video and kind of get in some of those groups we were talking about, some of those masterminds to dig into some of the terms that she mentioned there. But it's true, like when a new owner takes over a property, you're going to have people leave, stuff is going to break. Maybe you didn't see everything in the due diligence, or you didn't check every unit. Just don't do that. Something's going to come up. So you want to make sure you have, those reserves. You want to make sure you're taking note of, your vacancy rates, and, just making sure you're prepared to execute your strategy and to stay afloat. You want to do better than staying afloat, but make sure you can protect your investors' capital for that first 6 months and even further on. So I'm going to ask you the same question for the passive investors. What are 3 metrics that a passive investor should be looking for when they're evaluating a deal?
Yes, so really the first one starts with the operator. That's really key. If there is one thing I would say is focus on the operator and really understand what is their background, what is their experience level, do they actually and if they're relatively new to multifamily or the asset class that you're investing in, what is their professional background and how does that relate to what they're doing today? Because again, there could be a very relevant experience and transferable skills that they're bringing to the table. But start with a track record, and if they have been in the business for a while, you want to understand how many deals they've done full cycle, if they've had any capital calls, how many, why, what was the result. Then the second piece is how they communicate, and you won't necessarily know that until you are in a deal with them, but there are things that you can look for while you're, so to speak, dating one another during those initial stages. How you're interacting, are they reaching out to you, trying to get to know you, are they responding to emails or text or calls or social media, however you decide to communicate with them. And again, even through those investment forums, people talk, right? So what is their reputation in the investment community? So track record, communication, and I would say the third one for the operator, I'm actually blanking out on the third one, but
No worries.
those are probably those two. That's where it starts from. And then on the deal, I think we talked about the 3 key metrics as an operator. You definitely want to make sure you understand as a passive investor what assumptions the operator is making when it comes to the top line revenue growth, the expenses, the cap rates, and the debt structure. Those would be probably the 3 I would mention, because we already talked about the reserves and such. So really dig into that, and there's a ton of free content to help you figure out what those questions are. I can share as well some of the articles that I've written regarding this topic. But really hone in on that, because it's those inputs that influence the outputs. So oftentimes you see very glamorous, amazing returns on paper, and once you open the hood and kind of look underneath and start peeling the onions, you realize the assumptions that went into that deal that looks so amazing are really not realistic, and that it's really, really tight. And if one thing goes wrong, those returns will not be projected, returns will not be met, and potentially could be even negative. But at least in the beginning, so definitely take the time to get educated. I don't want to get too technical, but it really, to me, starts with knowing the operator, their track record, ability to execute, and communication. And then if you want to take it one level deeper, then the step 2 would be, again, learn some basic underwriting skills, just so you know what questions to ask as you figure out the inputs for the outputs.
No, I appreciate that. And I would just say, like any investment, like what Bessie is saying, is you have to get some education. So whether you want to be on the active side or the passive side, there is a wealth of content out there for you. So we mentioned like online, YouTube. I would say your operator or the company that you're going to invest with should be educating you. So Bessie, I love your articles and your posts because they're educational for me, right? You should want to, not all of them are going to do that, right? But a lot of them are putting out that content such that you can understand what the investment is. How are you going to get paid? How long is your money going to be in the deal? Is it in line with your risk profile, your risk tolerance? So I think you have to have an honest conversation for the passive investor of, your risk tolerance, your risk profile. Can you afford it? What mechanisms you can leverage to invest. So a lot of people don't know that they have their 401ks, like maybe they've changed companies, they can leverage their 401ks and like move them into a different investment vehicle. Some people have cash, some people inherit money, they don't know what to do with it. So there are a lot of ways to kind of get started into multifamily investing or the investment vehicle of your choice. But again, you want to make sure you have a good fundamental understanding of what you're putting your money into. So don't just go blindly. So Bessie, talk to me a little bit about your strategy moving forward. I know you gave us like 3 things to look for on each side, but as we approach 2023, where we're thinking a lot of opportunity will be in the market, there are going to be people who can't refinance due to the higher interest rates. There might be some fire sales. Like, give us the details of your strategy moving forward.
Yeah, so I definitely remain optimistic long term about the asset class, specifically in multifamily. And I stay in my lane. Like I said, on the active side, I just do one thing and one thing only, and that's multifamily and residential. So I stay in that space. So because of that, I'm a net buyer and remain patient. The last year or so has been quite challenging, not only because deal flow has been down, depending on the market, anywhere from 50 to 70%, but even the deals that are coming on the market have very thin, or in some cases negative margins, just because there has been a pretty wide gap between buyers and sellers. I think that will be changing in the coming months. Why? Because there are a lot of maturities coming due. So sellers will have to make a decision whether to refinance, and most likely bringing in some more equity, particularly if they bought in the last couple of years, or they'll have to sell. So that will trigger some activity in the market. I'm not sure how bad necessarily it will get. There's a lot of talk about distress, but one thing also to remember is that lenders are also not in the business of foreclosing. They're not just waiting there, salivating, waiting for the property to go bad, right? They're in the business of lending money. So for the borrowers who are performing, who have a good track record, who are transparent in communicating, and who have decent amount of equity built in, they'll probably work out solutions. So some of those deals won't necessarily hit the market, but there will be others where people are sticking their hand in the sand, hoping the storm will pass, and kind of oblivious to the facts. And in those cases, we'll probably see some distress. where you have great assets in really good markets. They just need to be recapitalized, or perhaps they were not managed as efficiently. So I remain patient, continue to underwrite it and look at deals. I've specifically for markets, I still look at deals in Jacksonville, Tampa, and Orlando, with particular focus on Tampa and Orlando. But the market there has become really challenging due to insurance, and with the hurricane going through there right now, I can't even imagine what will happen to premiums next year. So that's caused me to look into other markets where perhaps I don't necessarily have presence, but I have connections with partners who are already operating there, have a big track record, their boots on the ground, and I can bring value with the analytics, lender diligence, underwriting, either initial underwriting or second set of eyes, plus bringing my own capital and that of my investors as a way to add value and take down those deals. So from that perspective, I've been focused on Georgia and Tennessee, again, states where I have presence. So you can probably see the theme. I'm taking a very incremental approach to growth, not spreading myself to look everywhere, just going step by step, state by state, property by property. Otherwise, it can be really overwhelming. But to sum it up, in the long run, remain optimistic about multifamily. A net buyer, have pivoted and changed my approach slightly just based on the market dynamics for my core market as well as the overall global markets. But those challenges haven't necessarily dissuaded me from pulling back from investing.
No, I like that. And I love that you're kind of slowly but surely, right?
Mm-hmm.
Calculated, expanding, evaluating your markets, building again that team. We keep coming back to like having strong team, which is like the boots on the ground piece, making sure you understand that market before just leaping in. And I think the other thing that you mentioned a while ago, which is focus. So many of us were just like, oh, this market is hot, or this market is hot. And like you meet all these cool people in these meetups, right? And at conferences, and you think that you can get into every market. And it's really not true, right? You want to be passionate about that market. You want to understand the economics there, the political influence there. You know, are people moving to that market? What's the migration rates there? Is it landlord or tenant friendly, right? Which can impact how you do things there. So a lot of key metrics to factor in when you are evaluating your target market and kind of where you want to do business next. Can you talk to me a little bit about just property management? Because obviously you're an out-of-state investor. What are some key things that you look for in a good property manager? And like, how are you vetting them? Because obviously a lot of us could just say, oh, you know, go here or go there. But, you know, what's made you successful in investing out of state as far as the property management piece?
Yeah, so very similar approach, right, to vetting the operator, and it really comes down to what is their track record and how are they communicating. So in terms of track record, you really want to understand how they're vetting tenants, screening tenants, how they're marketing the property. Once a tenant is onboarded, how are they taking care of the maintenance request or any resident complaints, and then how are they handling the turnover when the tenant indicates they will be moving out and not renewing their lease. So you really want to hone in on that. And then as far as communication, other than the general, how are they communicating? Are they responsive to you? What is their reporting? Do they have automations portal where you can easily access your information? Do they share information? Because not all of them do. And are they open to discussion as you read through the property management agreement? Sometimes these are, boilerplate, but there may be clauses that perhaps don't align with your approach or your business plan. So you want to have those discussions up front and not after you sign the property management agreement. The best way to find property management is through referrals. But even then, one thing to keep in mind is just because that property management firm worked for the person who referred them to you doesn't necessarily mean it's going to work for you. because again, they may have different objectives or business plan. They may have different scale from you, and especially when you're starting, you're a small fish in a big pond. So you're constantly screaming for attention, but that's key, right? Don't assume that just because you signed the PMA, you can sit back and relax, because again, the property managers usually have a number of properties that they're tending to. So if you really want to be top of mind, one, you need to be very clear up front with what your objectives and your business plan is, then hold them accountable, communicate frequently, follow up, to again make sure things get done and get executed. Otherwise, you will very easily fall to the bottom of the priority list.
Right. I definitely agree there. And I know one challenge that I had personally is in one of my properties, we had brought in a property management company that had been successful with that that team who was kind of putting the deal together. And it proved to be very expensive because a lot of this happened while rates were increasing. The market was getting more difficult to enter. And so the goal was that property manager would grow, like we would acquire more properties, they would have more properties to manage, therefore kind of leveling out the fees. Turned out to be very expensive. So it was just one of those decisions that we had to make, you know, as a team, of bringing that group in and then how long to keep them there to prove their value. And then you just hear of these, alternatively, you hear of these horrible property managers, right? Where they're neglecting your property. They don't have the experience. Maybe your property isn't in their wheelhouse. Like maybe they're used to Class A properties, but maybe you have a C+ or a B-. So definitely doing that due diligence, getting referrals, making sure they have experience with your property type, is all like key metrics to finding a great property manager. So talk to me a little bit more, just about how the passive investor can get started. So like for somebody here today who might be watching, how do they prepare themselves to get started in their first deal? And then I like to go both sides. So for the active investor, maybe I've done some single family properties. What should I be preparing to do? We talked about team, but what does it kind of need to look like for that single family investor or that stock investor to get their first deal? So let's start with the passive first. How does someone who's a passive investor get into your deal?
Yes, so we already talked about education, which is, I would say, that's where one should get started, finding the operators that you potentially want to work with, and then getting onto their list so you can see the deal flow. One question that I often get from people is, well, where do I find the money unless you already have that excess savings set aside, which a lot of people do, but not everyone does. So there are a few resources one can tap into. One is the self-directed retirement plans, which these are not traditional IRAs that invest in stocks and bonds, but self-directed retirement accounts that you can channel towards other investments outside of stocks and bonds, like real estate, for example. So that may be one possibility or one liquidity source for people to tap into. Life insurance policies, that's another source. When you start getting those life insurance policy loans, my only caution there is you want to make sure that the investment return that you'll be earning on the opportunity that you're contemplating exceeds the interest rate that you will effectively charge yourself for borrowing that money. And that same thing applies to HELOCs or any equity lines of credit. Again, you don't want to over leverage yourself or take on a HELOC loan or do a cash out refi at a rate that's higher than what your expected return on investment is. So in the current market, that's probably more challenging, but previously when rates were 2-3%, that was a lot easier, and syndications were returning 10 cash on cash, right? That was a lot easier to accomplish. But these are just a few liquidity resources one can tap into, and when you have the education ready, a couple of potential syndicators that you think you may want to work with, and your focus on particular asset class that you're interested in, then it's just really starting to evaluate deals, attending those webinars, asking the questions, because you build experience that way. You learn, and eventually taking action. I know it's the very first deal is going to feel very scary. I remember when I wired my first passive investment check, and I was like, oh my God, what happens next? And like it's a scary moment, but it's also been very rewarding. And again, the only regret I have is not starting sooner.
Yeah, it is so scary. I just wire like 50 grand and you're just
Right,
like, where did my money go? In the black
right.
hole. No, but one of the things, and I'll try to improve my question. One of the things I think as a passive investor is there are opportunities that are for what we call accredited investors, right? Where you make a certain amount of
Yes.
money or have a
Yeah.
certain level of income or net worth.
Mm-hmm.
Those might be the deals that you'll see advertised on social media, Facebook,
Mm-hmm.
or
Mm-hmm.
platforms like this. And then there are non-accredited investors or sophisticated investors, and a lot of those deals that you'll see are through your network. So you have to kind of be introduced to those people. They can't be advertised. They don't have as many income requirements, right? But you still need to be knowledgeable. So I would just say, for those of you watching, just dig into your accreditation status. How much money do you make? Do you make over 200 or 300K a year? Do you have a net worth of over $1 million? If not, then you would be considered non-accredited, and then you kind of just need to network for these deals. So there are deals everywhere all the time. We talked at length about evaluating deals and doing your research, but that's how you would find the deals, through your network, and just making sure that you can take advantage when those opportunities come out. And I like to throw numbers out there, and I'm gonna give you the sticker shock. Most investments require 50K.
Yeah.
I have seen some as low as 25 and 30. So just prepare yourselves. A lot of people, they're like, when they hear that number, right? But again, in a lot of our deals, we are offering 2 times your money, an equity multiple. We won't get into all the jargon, but we try to give you returns of like 1.8 times or 2 times your money. A lot of that is changing this environment, so the returns might not be as great, but that is still so much better than your money sitting in the account getting like less than 1%. So let's remember that. So to improve my question, for the active investor, if they're ready to come into a deal, what do they need to look like financially? Or maybe their personal statement to be attractive? Like, let's say I wanted to partner with you, Vesey, to do a deal. Like, what makes that active investor look attractive to you, maybe financially?
There are two things from a financial aspect, right? If you're going to be one of the key principals on a deal, very often lenders will have minimum net worth requirements to equal the amount of the loan, minimum liquidity requirements post close to be 10% of the loan amount, and then minimum experience level. That varies from lender to lender, but it's anywhere from 3 to 5 deals in the past 3 years of similar nature, right? If you're only doing 10 deals and all of a sudden you're doing 100-unit deal, that's a little different. So that's from financial slash lender pre-qualification requirements. And again, it's a team sport. So if you're not at that stage yet, that's why it's important to build relationship with other partners who may be able to bring that to the table, bring their liquidity, net worth, and experience to the table. And that actually leads me to the second point is what type of skill set you're contributing with, because it's important to have complementary skills, not overlapping skills, right? If you have a group of underwriters and we all decide to do a deal together, but who's going to bring the capital? Who's going to run the asset? Who's going to sign on the loan? These are all things that need to take place in order for anyone to take a deal down. So it's important to ensure that there isn't that overlap in skill set, unless it's a pretty large deal, right? Maybe you need 2 people on the asset management, a couple people usually on the capital attraction side, and then a couple people on the acquisition doing diligence, the constant underwriting evolutions, and so forth. But again, it boils down to having complementary skill sets. And last but not least, and actually usually this is where I start with before I even look at numbers or experience, it's really values. Because if you think about it, you're getting into a marriage. In some case, it's a lifelong marriage if you're looking at smaller JV deals or forever buy and holds. In other cases, you kind of have the divorce planned, right, 5 years from now, but it's 5 years where you'll be living together. So you want to make sure that your values are aligned, because you'll be in partnership with these people, hopefully for not just for one transaction, hopefully for many transactions. And especially during tough moments, which inevitably anyone will encounter if you've been in the business long enough. It's important to see how people handle themselves, how they interact. Do they come together as a team and with a solution-oriented approach, or do they all of a sudden start getting angry and pointing fingers at one another? And you can't really predict these things, unfortunately, but that's why it's important to take the time, get to know people, network, attend those forums online or in person, and build those relationships over time.
No, I love that. I love the values portion. I've seen values and personality. I've seen some people or heard some people take like Myers-Briggs assessments or all of those like personality assessments, because you're going to be working together pretty heavily, for that 3 to 5 year duration. And I think it's so key. I think sometimes, in this world of social media and like we never see each other, people put their best foot forward, but then it's not until you like get into that agreement that you really figure out who people are. So definitely take that time to do the extra due diligence. I like to say meet your partners in person. Like find a time or common place, fly out, drive out, try to meet in person. And then again, like Bessie's been talking about this whole time, it's just doing your due diligence as far as skill sets. So I think anybody can probably say they're an underwriter or I'm a great asset management, but like what is proving that skill set? So I think having those hard talks, and even if you're a newbie, if you're just beginning out, what is your experience? Is this a role that you're just trying on? Are you trying to get this skill set? Or do you have a proven track record, right? Having those open conversations and dialogue is going to be critical. So I do want to pause real quick. I know we have a few people who are live. If you have any questions, we got about 7 minutes left on the webinar. If you have any questions, I am hoping that the Q&A feature is working. Feel free to ask us a question. I'm gonna pause there.
And one point I will add while we're waiting for the questions to add, as far as partnerships, is also the communication style. And that partly relates to values, but it's slightly different, right? How quickly people respond to emails or texts or phone calls? Are they an email person, phone person, text person? Do they work late at night? Do they work on weekends? Because if you're used to working on weekends and you don't hear back from them for 2 days, right, you're gonna get you'll be crazy, right? Why are they ignoring me, right? So it's important to figure out some of those nuances. Are they a morning person, evening person? Just or at a minimum, set those expectations straight up front, just so there isn't any miscommunication from that regard, and when you can expect responses, how quickly, how detailed, and so forth.
Yeah, I have that at work in my W-2 where we had to have a meeting, and like we have this one guy who likes to work late and he expects responses like in an hour, and it's like 6 p.m. And then we have other people who are up at 7 and they're like banging out emails, and we're like definitely critical for the communication piece. I want to go back as we just wait for questions. Nothing yet. Nope, nothing yet. I just lost it. Never mind. Well, if I remember, I'll definitely ping you separately because I love chatting with you. So I appreciate your time today, Bessie. I appreciate all the value and the insights that you've shared with us. I really appreciate it. I know I'm just getting started out, and I know you took the time this morning to share with us. So thank you again for your time, and I appreciate it. So
oh, thank you. No, thanks for having me. I know we've been talking about it, and I'm just so excited to see how far you've gone, and I know we talked about the webinar a while back, and now it's coming to reality, and
That's
really
great.
humbled and honored to be one of the guests here. So thank you so much for having me.
I appreciate it. We got one. I feel like something was coming. How long will it take to grow into an accredited investor if you only have $100,000 cash reserves and not a huge salary? Do you want to answer that? What your opinion is? I'm going to say it depends. It depends on the investment
Right.
returns. It depends on actually executing on that investment, right? You know, they might promise you that you're going to double your money in 5 years,
Mhm.
but
It,
circumstances change, the market changes, and maybe they can only give you 1x or 1.5x. And
yeah.
it really just depends on the investment type and vehicle. So I don't know if Bessie wants to add some color to that.
Yeah, and these are all great points. I would say the two most common factors for accreditation are the two that we discussed, the income and net worth. But there are other factors that the SEC considers in order for anyone to be an accredited investor. And you can easily look those up on the SEC side. But if you're a registered broker dealer, have your FINRA license, if you're already managing a fund, that's one way to also get accredited. There's a lot of talk right now that the SEC will actually be changing the accreditation guidelines, meaning raising the minimums. We'll see how much they raise those too. But as part of that change, they'll also be offering people the opportunity to get that accreditation by taking a test, because there are a lot of sophisticated investors out there who have a pretty deep knowledge of real estate and financial markets. They're just not at a place maybe at this very moment where they can meet those qualifications, but that test will give them that ability. And then last but not least, there are third-party providers. For example, like Reg D is one company that helps with getting your license. I think Series 65 or 63. I don't want to misspeak, but you can look them up. And again, it involves taking a test and going through a process, and they help with some of the administrative component of that. But there are ways to do it. If there's a will, there is a way. Of course, the other option is let the factor of time do its magic, and that may take a while, because again, real estate is not a get rich quick, but I would say get rich for sure kind of plan, and it takes some time, probably a few years. So if you're patient, that's one route. Otherwise, there are other alternatives through those certifications and tests that can allow you to get there faster.
I love that answer. I didn't know about the Reg D option there. So I'll definitely look into that myself just so I can better educate others. The last question, I just remember what it was, is what, as an active investor, what made you comfortable to invest passively? Like, how did you put on those two hats? Because I feel like that's a lot of challenge. That's a big challenge with a lot of investors I know and a lot of people that I come across. They want like those joint ventures, they want to own it, they need high equity. Like, what helped you to put on the passive investor hat as an active investor?
Yeah, ultimately, that's what I want to be. I want to be fully passive. Right now, I think I have too much energy in me to be completely passive, which is why I'm doing the active side. But it really boils down to the same fundamental principles. You really need to understand the underlying business model. Don't be afraid to ask questions, and sponsors should be willing to answer those questions. And if they don't, then walk away. There will be another investment opportunities. I've been presented with a lot of, say, oil and gas deals. And again, in my case, my passive investments for the time being is how I diversify away from the residential market, because that's where all my active holdings are. And so I was presented with I think it was a carbon capture oil and gas deal. And as I started drilling into it, well, first it didn't meet my key investment criteria. And for me, that's cash flow and moderate returns on a risk-adjusted basis. So I passed and didn't dig deeper. But I was evaluating that opportunity and started asking questions to really understand the underlying business model, it seemed like a pretty gray area. So I passed, and later on, actually, it turned out that there was a fraudulent scheme going on with one of those investments. I'm not saying that's with all it with one particular operator. So it's okay to say no, because again, you need to make sure you understand fully what you're putting your money behind. And if you don't, if the operator can explain it to you in simple words, or if you're hoping, or if you're investing just because everyone else is doing that, um, I would say pass. There will be plenty of opportunities for you to consider.
Awesome. Yeah, I know for me, if I don't understand it, I definitely don't invest in it. And I mean, obviously, my goal, like you, is to be passive. Ultimately, is to be passive. And so for me, I understand that I need both those active and passive investments to be making sure all of my dollars are at work, right?
Mhm.
But again, Vessi, I appreciate your time today. I pray that you have a great day and no rain, no storms over there. I think everything's moving on the East Coast now, but I thank you for your time, and I wish you a successful raise. I know you're working on your raise and you're getting your final few dollars in. So good
Thank
luck with
you.
that. All
Thanks.
right.
Yeah,
Well, I
really
appreciate
excited.
it.
Thanks for having me. Have a great day.
Everyone have a good one. Thank you.
Thanks.